Good morning, everybody. How you doing? It's Tuesday already. Well, is it really? Yes, it is Tuesday, September the 14th, 2021. It's your Uncle Bruce here, Stock Markets with Bruce from Calgary, Alberta,
Yes, it is Tuesday,
in
September
Canada.
14th,
Welcome one,
2020.
welcome all to today's show, where we try to explain to you folks what's happening in the stock markets in plain English. And some days are easier than others. I'm just waiting right now for the so-called inflation data report to be released. We should be hearing the latest estimates on what kind of inflation numbers are going on. And I'm not sure if there's much to be excited about. I personally am of the opinion that whatever inflation is showing up right now is really what we call, the word is transitory. And now, in plain English, what does that mean? Temporary, transitional, where the economy is going from a dead stop to a restart, and there are glitches in the system here and there. Plus the odd hurricane kind of thrown into the mix for those of us who follow hurricanes and weather systems in, say, the Gulf of Mexico, or right now in Houston. There's a transitory thing happening in the Houston Dallas area. It's called a tropical storm, which is transiting a bunch of rain from the sky onto the ground faster than the ground can absorb it. That's a transitory issue, temporary. It's just a temporary flood. Don't worry, Mr. Jones. Your house is flooded, but only temporarily. You'll be fine in a couple hours. Oh, that mold down there, you can scrub that off yourself. Don't worry about that. And don't call the insurance company. They're not going to cover that. Here we go. 12-month increase in CPI slips to 5.3 from 5.4%. So the transitory inflation rate is down 1/10 of a percentage point as opposed to what it was last month, I guess. Nothing burger. I need to improve my strategy to take advantage of quarterly earnings report periods. Example, GameStop. Last time I wrote much too early and too low a strike price help. This is one of those things where I can't tell you how the stock's going to react each and every time they come up with reports. The last time, not the one we just had, but the one before, we witnessed the shares go from this 160, 70, 80 range to the 210, 20 range to the 280 range to the $330 range. And then unfortunately, over months, weeks, come back all the way back to the 160 range. This time around, we went from the 155, 65, 70 range, got into the 200 range, 210 range, got up to 230, and that was it. Nothing above 235 or something like that a share, and back now to 200 a share. Here we are. It's not the same as last time. It may be a slight mirror effect, but nothing like before. So next time around, I have no idea what to tell you what's going to happen. I cannot say. You have to take the attitude of, I'm going to write call options against my stock, and I'm going to make my stock pay me to hold it. And if the stock wants to go up, I'll roll my contracts. I'll just roll up and say, hey, okay, I'll go with you. I'll write at a higher strike price and I'll go further out. But if the shares begin to falter and back off, I'm going to either just do nothing, just do this, and watch the deterioration of those contracts I just wrote for a nice buck. And I'll wait to cash them back in. I'll buy them back at a real discount. And then I'll roll into closer in, lower exercise price contracts to take advantage of price deterioration closer in. I mean, that's how you have to play this game. Is there any point to not roll over and just let yourself get exercised on a covered call that ran on you, assuming you have the cash to buy back? I don't believe in getting taken out. I really don't. I don't think that is the way you should go. I really believe you should roll over. The reason to me is, for example, I had investors, viewers here who were writing 180 contracts on GameStop, and the shares went up. And they got into that 210 range, and they wouldn't go back to 180 right away. They were just kind of hanging around there, and then they went a little higher. And so what they did is they did a rollover, and they bought back their 180s for higher than they paid. But even buying them back at 40, they turned right around and now wrote $240 contracts, 250s, some even as high as 280s, out to January next year or even April. And they decided that they would take a much higher exercise price of, say, 280, write April contracts way out there, and brought in like $55. So they're paying $40 to buy back a call that they had written originally at maybe $20. So they lost 20 on the first position, but they turned around and wrote a new contract at not only the $40 level, at 55. They brought in another $15. In effect, they're now sitting on $35 a share cash premium from the $20 first contract plus the $15 add-on on the second contract. They have $35 a share cash on hand, which means that if the shares back off and those contracts, those 280s, go from the 55 level down to 35 or lower, they're now ahead on the entire contract. Keep in mind that their shares have gone up from the 170-80 level when they first wrote that first contract to the 210-20 level. So they're richer on the stock, and they're going to be richer on their calls. And sure enough, that's what has happened. The shares have backed off from the 220, 230 level. We're now in the 199 level right now. And these $280 calls, which are $80 out of the money now, instead of being $50 out of the money, they're $80 out of the money. They're backing off. And as each day goes by, more time is evaporating, albeit it's a little bit of time at the moment because Aprils have a long time to live. Nonetheless, each week there's less time, but there's also the price factor. Now, when the shares, these shares have fluctuated, obviously. If these shares touch 190 today, that would put the contracts $90 out of the money. And so the idea that the contracts could go from, say, that 55 level, they could be now at 40, they could be at 30 this afternoon, for example. They could be 25 later this week if the shares want to hit 185, 182. We know how intraday fluctuations take place on GameStop. This is the advantage as a writer that you have. You get to, quote, day trade contracts that you can write, knowing that the clock will bail you out to a great deal of that premium. If you're still incorrect and you write a call out of the money with all premium on it, it will shrink out. So these Aprils can be reacquired, even if you pay, say, $40 for a contract that you're into it for $35 for. You're still down $5 if you buy them back at 40, but they did come down from 55 to 40. You now are turning around and rewriting a new contract that might be October's, and they might be October 210s. You might write November 210s or December 210. You're going to write contracts that are closer in on time and on price, and you're going to still bring in $40 a contract. In other words, you have a $40 call that you need to buy back, but instead of having to wait until April for it to expire, you're now down to December. And if the shares back off even further, you can buy those calls back and now write November contracts, and you're bringing the time factor even closer to you, which means that instead of a call having 160 days to live or 120 days to live or 90 days to live, it now has 45 days to live, and every day is 1/45th of that contract's life. Evaporate. And that accelerates the downdraft. And that is the key to this game, is to make the clock eat the value of the contract against the bettor that's betting against you. You're the casino. You make the rules. You get to change the rules for the bet you're making. You're not locked in to that first option contract you wrote. You're only locked into that deal as long as you keep that option contract short position. You can roll out of it into another anytime you want, and you can extend the time the contract has to go, raise the price of the exercise, or lower the price of the exercise price and shorten the contract game at your whim. And you're just moving. You're literally saying, I don't like this game anymore. I'm going to another table. I'm going to go to this table over here, this blackjack table, and I'm going to set the rules here for this game. And you're going to take on a new position. This is what I love about writing options. The total flexibility that you have in front of you. If I wrote some 750 puts on Rocket Lab for $2, are they going to be exercised if the stock is at 16? Well, most option players that write contracts, buy contracts, trade contracts, they don't want to exercise at all. They never want to exercise. They really don't. They're only interested in capital gains on the contracts. Whatever position you take, you're taking the opposite of the seller or the buyer on the other side of your trade. You have your reasons why you're making your move. They have their reasons why they're making their move. And this is strictly a capital gain wager is all this is. So don't worry about being exercised by writing a call in the money or anything like that. Don't worry about it. It's unlikely to happen. It can happen, yes, and the broker will make you put up margin to cover that possibility, but it's rather unlikely. Well, on average, it's unlikely to happen unless you're dealing with a contract that is about to expire tomorrow, the day after tomorrow, and you're in the money. If you're not going to unwind your position before exercise, yeah, of course you're going to get exercised, obviously. But if it's 2 weeks to exercise, or it's a month away from exercise, or it's 4 days away from exercise, you're going to be trading that contract for the next couple of days or weeks or what have you to move into another. I hope all is well in Calgary. Where do you think we go from here on Rocket Lab? I have puts that I'd like to offload and long calls I'd like to rebuy. But I also want to rush in. Mr. T, I think you just sit back and relax and let the stock do what it does. It's going to go up and down and up and down, but the general pattern, I think, for Rocket Lab is into the $25, $30 level and beyond. And this is where it's headed. Sooner or later, that's where it's going to be. You've got to, however, allow this stock to gyrate. This is what it's going to do. It is going to jump up and down 50 cents in 5 minutes like you can't believe all the time. It might have $2 days up, $2 days down, or more. The higher it goes, the more volatile it might be for a while, because this company is being discovered every day by hundreds of thousands of people who've never heard of it, who are looking into it going, oh, wow, this is pretty cool. Here's a company doing something. I knew that satellites got launched, but I had no idea that a company like Rocket Lab does it the way they do it, or that they have such a backlog of business, or they have such a diversified company. You have to let this stock become discovered. Many of you who are watching me here on Rocket Lab now, you've become experts on Rocket Lab because you've been listening to me talk about it for 6 months. Well, you got a 6-month head start on the intelligence of Rocket Lab, whereas the street has 5 minutes of knowledge about Rocket Lab, and they got some catching up to do. So give the stock time to become discovered by many, many, many millions of new investors who will pay much more per share than you ever paid because they came in later. You're just in early, and way to go. Would you recommend buying options on Apple due to show and tell today? Well, I like Apple, period. I just like it. The lower the stock goes, the more I like it. But I would be buying call options into next summer, way, way up. Like, that's the only way I would buy call options on Apple. I'd like to go way out. If you can afford in the money contracts, you're better off. But the problem with that is you might have to put up $3,000 or $5,000 for a contract to get a decent priced contract with not too much of a premium. But on the other hand, if you buy 160s for next year, you might pay much, much less per contract and get many more of them, giving you leverage. So there's this proverbial, what do I do with this investment? Do I buy out of the money calls on Apple to get the leverage, or do I buy in the money calls with a lower premium? So if the stock goes up $5, my contract goes up $4.50, $4.25, I get $4.25 of the 5, rather than the stock goes up $1 and I only go up 15 cents on a contract because I'm so far out of the money. There's this back and forth thing you got to wonder about. Folks, check out stockmarkersbruce.ca, catch a lesson 2 or 3 or 4 or 10, and become a little smarter than others. You only need to be smarter than half of the market players.